Welcome to today's session. So today we are going to continue our discussion on chapter number 14, unit 2, that is previous session. Can anyone tell me? I'll start with a quick quiz and a few questions that you need to answer quickly so that we can, understand that these are divided. Layers in which the NBFCs are divided. Very good, Kanaya. Can you name them quickly, like, just the short form? So you can basically write the answer, or if you can unmute, then speak the answer. Very good, Kanaya. Yes. Anyone else? Anyone? I think still the voice function is some issue in that, so we are working on that. So you can write in the chat box. So what are the layers in which the NBFCs are divided? Various layers. Okay, so there were 4 layers. That is base, middle, top, and upper. Okay, so upper and then top. Now, we also discussed some exemption criteria. Can anyone tell me which are the exempted, and what was that category of the NBFC? What we call, which are the exempted NBFC based on the amount, customer interface, and the deposit? Anyone? Unregistered type 1 NBFC. Yes, very good. Very good, Radha. So unregistered type 1 NBFC. We discussed then the NOF requirements. We discussed then the tier 1 capital, tier 2 capital. Now, can anyone tell me what is the difference in tier 1 capital for a base layer and for the middle layer? There is one particular item that we are not required to consider. PDI. Yes, absolutely correct, Radha. So perpetual debt instrument, you are not required to consider in the tier 1 and the tier 2 capital for the base layer, but you are required to consider for the middle layer. Okay. Now, very good. Now what we will do, we will discuss further with respect to the provisioning requirement that we started in the last session. Okay, so we will first start with the what is NPA, and we will go back and have a quick revision. So can anyone tell me what was the due date or the number of days if something is outstanding or overdue? It will be called an NPA. What was the number of days? Very good, Kanaya. 90. Earlier it was 180. Yes, Radha. Very good. It is 90 now. Very good. Yes. So now we are talking about provisioning requirement, where we are talking about NPA. And when we talk about NPA, we are talking about 90-day limit. Remember, we discussed that for NBFC base layer, basically, we are talking about there's a 90-day limit. Okay. And basically, this particular limit that we are talking about is now being updated based on the glide path. So earlier it was 180, but we had to consider 90. And if something is of the previous year before 2026, then it's 120. But after 2026, everything is into the 90-day criteria. Great. Okay. Clear till now? Any doubt till time this particular level? Any doubt? Any doubt? No? Let me proceed then further. So now what we will do is, if we understand this NPA criteria, we need to understand now a criteria with respect to the classification of asset. Because remember, when we discuss about the NPA criteria, we started with the asset classification. So we need to understand how we need to classify various assets. Okay, classify various assets. So once we understand the classification, and that classification is on the basis of the NPA, then we will go for the provisioning. So asset classification. Now asset classification, again, I will divide between NBFC base layer, NBFC middle layer. Okay, I will divide in between these two, and then we will see for the bit of upper layer also. Now, when I talk about standard asset, can anyone tell me what do you mean by standard asset? If you have some, read somewhere, if you have gone through the study material till now, or if you have, read the guidelines or these regulations, what do you mean by standard asset? In simple terms, if I summarize, the standard asset is normal asset, normal loans and advances where there is no NPA. Okay, so no NPA is your standard asset. That is for both of the scenario. There is no NPA involved in that. There is no NPA involved in that. So it's simple standard asset. That means there is no NPA plus there is no heightened risk, or there is it is not carrying any problem, or it is not carrying any risk, okay, more than normal. So if you see the definition of the standard asset, it's not only on the no default, that means no NPA, okay, but it also says that which, okay, does not disclose any problem or carry more than normal risk. Because sometimes on the basis of the risk we do classify NPA, just for your understanding. But as of now, for a simplistic simple and standard understanding, no NPA is your standard asset. Fine, great, no doubt till now. Okay, straightforward. Now let's go a step further and discuss what is substandard asset. Anyone? What is substandard asset? Anyone? What is substandard asset? For 90 days, there is a default in the payment of interest. Okay. For 90 days, there is a default. But, okay, NPA less than 18 months for base layer. Yes, absolutely correct. Very good, Kanaya. Very good, Radha. So now we are going to, category of a substandard asset. Now, substandard means it is non-performing, but for a period not exceeding 18 months. So let's go back to our timeline. Okay. So when we discuss the timeline about the asset classification, I said, okay, this 90 day, as of now, what I'll do is I'll remove this 180 day because it has been, old. It's not applicable. We follow this 90 day. From this particular date, okay, from this particular date, let me take one more. Yeah. Let's say this is another date. So these are 18 months. Let's assume from the 90th day, this is 18 months. Now, till these 18 months, it will be known as a substandard asset. Okay. It will be known as a substandard asset. So from the date when a default was made, from that date to the date when, basically 18 months are not expired. So I'll take this one. Wait a minute. Okay. So let's say this is a 90-day mark which is there, and sorry. And this 90-day mark, if I'm talking about from this particular date to the date where basically 18 months have not expired, this is known as your uh, substandard asset. Okay, this is basically a substandard asset. Fine, we understood. From this particular date to this particular date, it is a substandard asset. Fine. But now let's understand what will happen from beyond 18 months. Okay. See, it's from the date I need to count when it become NPA. Okay. So once it becomes non-performing asset, it starts to being a standard asset. And we have to count from the day when it became the non-performing. That is by after completion of the 90 day. Okay. So after completion of the 90th day, from the 91st day to 18 months, from 91st day to 18 months, it will be substandard asset. Simple. Any doubt? Any doubt in this? Okay, no. Now, as of now, we will ignore this part because we will cover it a bit later on. As of now, ignore this because it's a very specific scenario of restructuring. So we'll not go as of now in this. Okay, that is substandard. Now we need to understand what happens once this substandard asset crosses 18 months mark. Okay, now a particular asset which remains substandard for period exceeding 18 months, that means it's the asset is non-performing, it has closed the mark of 18 months also. That means we are into the 19th month. Now the moment that happens, it becomes your doubtful asset. Simple. So doubtful asset basically is nothing but a asset which can be a term loan, lease asset, hire purchase assets, okay, or any other asset which remains substandard for a period exceeding 18 months. So the moment you exceed 18 months, it becomes a doubtful asset. That means in our this example, okay, so let's take this example, and from this particular date to sorry from this particular date to the future date, whatever it may be, it is beyond 18 months. This period is beyond 18 months. And here we have a doubtful asset. Okay, we have a doubtful asset. So by this way, the asset becomes substandard and doubtful based on the NPA criteria. That's how it works. Okay, so when I talk about substandard asset, it is NPA for 18 months or NPA but up to 18 months. And doubtful NPA for more than 18 months. Clear? Straightforward. Nothing difficult in this till now. Now, the question comes is, if this is the scenario, then are we required to classify further these assets into various categories? The answer is yes. Okay. So there is a further classification required for these kind of assets. When I say doubtful asset, I need to classify further what kind of doubtful asset it is. Okay. So it is up to 1 year, it is up to 3 years, or it's more than 3 years. Now, from which date? I need to consider the date when it becomes doubtful. So period for which the asset has been considered as a doubtful. Okay. So let's go back to our timeline. Let's say this is our timeline. Okay. And in this particular timeline, I have various, like here, let's say it is 1 year. Over here 1 year, and here let's say it is 3 year. So after it became doubtful, so this is the point where asset became doubtful. And from here 1 year, 3 year or more, okay, from here 1 year, 3 year or more, I will categorize into buckets. So if you see, when I say doubtful for 1 year, if I talk about this particular part, doubtful for 1 year, so it's not only doubtful for 1 year, that means I have a 90-day NPA, number of days involved, plus I have 18 months of substandard, then plus I have 1 year of being doubtful. Okay, so this particular point basically involves these many steps. So when I say 1 year, it's not 1 year from the date when it became overdue. No. So when it became overdue, for that particular 90 days, I have to wait to become an NPA. Once it became NPA, for 18 months, I waited to become it a substandard asset. And after 18 months, it jumped into the category of a doubtful. And when I say jumped into the category of the doubtful, 1 year again, I'm waiting for waiting for becoming it to be 1 year old doubtful. Okay, 1 year classified, 1 year bucket of doubtful. So you may see doubtful up to 1 year, but behind that, when I say doubtful up to 1 year, behind that it is 90-day NPA, 18 months your substandard, and then 1 year additional. Okay, so when I say doubtful asset up to 1 year, you will now understand how many days have been passed. It's not something that we are saying only 1 year, so 1 year has been passed. Although it is named like this, but in actual, there are multiple days behind it. Okay, so doubtful, I will divide into categories up to 1 year. Okay, then from 1 to 3 year, and up, and 3 year and beyond. So more than 3. Okay, so I'll divide into the categories, and there is a reason why I'm dividing into the categories. Okay, so when I say up to 1 year, it's a 1 year basically when it became doubtful. So this is I will write over here, that is when it became doubtful, from the date when it became doubtful, from date when it became doubtful. Okay, the reason, because we now will go for a next step of the provisioning, and this bifurcation will help us over there. Okay, now there is fourth category, which is known as a loss asset. Can anyone tell me what is loss asset? What is loss asset? Anyone? Doubtful beyond 3 years? No. That's where we need to understand. Loss asset has nothing to do with the NPA. That's the only category of the asset which is not running on the NPA. Okay, so loss asset, there are two criteria to identify. Okay, loss asset, there are two criteria to identify, and let's understand that. So an asset which has been classified as a loss asset by the NBFC or its internal or external auditor or by RBI during the inspection of the applicable NBFC, and to the extent not written off by the applicable NBFC. So there are two conditions: identified as loss asset plus not written off. That's the one condition. Number two, An asset which is adversely affected by the potential threat of non-recoverability. Now, very important part over here it is that potential threat. It is not required to be an actual threat. Again, I'm talking about potential, not actual. So there is a potential threat due to the erosion of the value of security or non-availability of the security or due to any fraudulent act or omission on part of the borrower. So if there is a potential threat of non-recoverability, okay, and that can be due to erosion of security. That means, let's say for example, I provided a land in collateral, but later on it was the land got disputed. It appeared that the land is disputed and I did not hold the appropriate title. So there was a erosion in the value of security. Or let's say there is something, let's say when I kept the land as a collateral, that land was near to a river basin, but because of the dam construction, now that land has to be, that land is under the river. It is non-usable land, and that has deteriorated its value. So there's an erosion in the value of the security, or there is no non-availability of the security. Okay, that means the security was provided has been destroyed, or there is a fraud involved in it, that the security that I provided was never existent into the place. Okay. Or anything that I have done as a part of the borrower that is causing these kind of potential threat. So if that is a scenario, it will be counted as a loss asset. So let's go back. So there are two conditions for the loss asset. Number one, inspection or identification plus not written off or act of borrower, and that is potential threat of non-recoverability. Okay. So that is a loss asset. If these two scenarios are there, any of the scenario is there out of these two, it will be classified as a loss asset. Fine. This is the classification of asset. Clear? Any doubt till now with this classification? Any doubt? If the land is disputed and I do not hold a good title, that means the bank is also not having a good title. So there is a dispute scenario. Okay, whether I did provide the appropriate documentation or like there could be a scenario that the bank may take that there is no title available to the bank and there are no documents available to the bank. So as a result, it can be a scenario that it may be counted as a loss asset. But again, depends upon case to case, and you need to see further details on that. Any further doubt? Okay. Okay. Now, when I talk about basically asset classification, okay, when I talk about the asset classification, this kind of classification, uh, this kind of classification will now help me to understand the requirement for the provision, because this is how I will now record the provision. So each asset classified over here has a different type of provisioning requirement. Okay, so each asset which I have classified over here, they have a different type of provisioning requirements. So let's understand now that provisioning requirements. Basically, when I say provisioning requirements, asset classification and provisioning. Okay. So when I talk about standard asset, do you think I need any provision over there? Do you think I need any provision over the standard asset? Yes or no? Any provision over the standard asset? Yes, sir. Yes, sir. And can you tell me the amount? If you say yes, there is a provisioning requirement over the standard asset. What provision is required? Anyone? Yes, no? Okay, very good, Kanaya. Okay, let me tell you. So when I talk about standard asset, okay, basically there is no risk involved in that particular asset, and that particular asset in itself is kind of, there is nothing overdue on it. Okay. So at that particular point in time, I'm not required to keep a higher provision in case of a standard asset. Yes or no? So when I say standard asset, that means I'm not required to keep higher provision. If I'll keep higher provision, then there is no point of saying that it's standard. So I keep a provision at 0.25% of the outstanding amount. Remember this. Standard asset requires 2.5% of the outstanding amount, and which shall not be reckoned for arriving the net NPA. And this is very important part that we need to understand. And that shall not be used for arriving net NPA. Why this is important? Can anyone tell me and what this means? Why this is important and what this means? What it means that we are not required to use this for the purpose of NPA. Let's understand with the financial report or the public report, annual report we have for one of the NBFC. Again, see, now when I say one of annual report for one of the NBFC, please do not focus on the name of the NBFC because it's publicly available data, and we are using for the purpose of understanding the topic. So please ignore the name of NBFC. Okay. Let me open and bring on the screen the data. And we will understand through the help of financial statement, because financial statement will show me this particular reason that what is the requirement now. Okay. So let's go to the financial statements. It is on the page 225. Okay. So basically we are on the independent auditors report and everything. That is something we already have seen in multiple annual reports. So as of now, we will not go into that part. We'll come in sometimes, but not now. Okay. Now, what we discuss over here is that means we the provision that we are talking about, we are not required to basically use it for the purpose of net NPA, but we have to show that that provision somewhere. Okay, so we have to show that provision somewhere in our books of accounts, but we are not required to net it off from the your net NPA. So let's go to the note number 21, which is provisions. Okay, this is another. Okay, just give me a minute. Let me. Let's go and see the standard asset provision directly. Meanwhile, it will search. We'll come here and I will show you something more, that where we are required to show this particular provision. If we are not required to deduct it from our NPA, then where we are required to show this provision. So there's a specific requirement for the financial disclosure of this particular provision. Okay. So this provision is required to be disclosed under the head of contingent provisions against standard asset. Okay. The provision towards the standard asset is required to be shown separately in the balance sheet. That means do not net it off from the your NPA and show it separately. So once you will calculate, you need to show it separately, that where this particular standard asset NPA, standard asset provision is there. Again, a bit of, because of the heavy file, it is taking time. So once it opens up, I will show you. Meanwhile, let's go back and continue. So you have to show separately this provision on the standard asset, and that is 0.25% of our value of the standard asset. 0.25%. Now, when I talk about substandard asset, can anyone tell me what is the provisioning requirement for the substandard asset? Provisioning requirement for the substandard asset. $15 to 20%, 25%. No, there is something more. Provision requirements on the substandard asset. Okay, so the provision requirements on the substandard asset, very good, Kanaya, it's 10%. Okay, on substandard asset, the provision, general provision is required at the 10%. And that's where it is again important, because we need to understand it's a general provision of 10%, not the specific provision. Now, what is a specific provision? Specific provisions are the provisions that you are required to make over and above the general provision. And is there any requirement to make specific provisions? Answer is yes. There are scenarios where you are required to make specific provisions over and above your general provisions, and that may depend upon the type of the asset, the type of the borrowing, and what is the risk involved. So it's not necessary that you are only doing the general provision of 10%. Sometimes it may require that you are required to keep a additional provision over the general provision. Okay, and then this additional provision is also required to be used and netted off from the NPA. Okay, so it's a general provision of 10%. Any doubt till now? Any doubt? Any doubt? No? There is one doubt. How can it be non-performing asset when it is performing asset? No, it's performing asset, but still you require a provision on that, on performing asset. Any other doubt? No? Okay. If no doubts, let's proceed for the doubtful asset now. Can anyone tell me what is the provision required for the doubtful assets? Anyone? Provision required for the doubtful assets. What provision do I need for the doubtful asset? There is something already on the screen, but again, tell me what is the provision required on the doubtful assets? 25, 40, 100. Yes, very good. Okay, good. Anyone else? Provision required on doubtful assets. Very good, Kanaya. Yes. And let's understand. See, when I talk about doubtful asset, that's where we have this particular requirement of year-wise division. Okay, 1 year, 1 to 2 year, 1 to 3 year, and more than 3 years. So for period up to 1 year, we have a 20%. For period 1 to 3 years, 30%, and more than 3 years, it's 50. Okay. Now, where is 100? 100% to the provision to the extent the advance is not covered by the realizable value of the security. That means if there is a realizable value, then I need to make a provision on the secured portion. So in addition to the above, in addition to the realizable value, like which is not covered by that, if there is a portion which is covered by the security, now provision from 20 to 50%, I need to make it based on the realizable value. So I need to bifurcate between what is secured, what is unsecured. So when I talk about up to 1 year, so as of now, I'm talking about only realizable portion, 20, 30, 50 realizable, 20%, 30%, and 50%. Now this is secured. Okay, again, if I write here secured. Now, let's do one thing. Let me, yeah. If it is unsecured, 100%, irrespective of the year, if it is unsecured, okay, if it is unsecured, 100% of the amount, irrespective of that. Clear? And 10% was 10% general provision on substandard asset. What is the provision required on the loss asset? What is the provision required? Very easy to guess. 100%? Yes, absolutely correct. So the provision required on the loss asset is directly 100%. Easy to guess. 100% of the value. But that means you are not required to write off. See, there is a confusion that, sir, when it is 100% provision, that means are we required to write off? Answer is no. And that's where, we need to understand it's a provision. It's not a write-off that we are doing. You have to book a provision in front of that and you will have the asset with yourself. But that doesn't mean that you need to write it off. There's a difference between booking a provision and, writing off the asset. Okay. So you are not required to write it off, but you are required to book the provision, and that is to be shown with the asset. It will be shown with the asset itself, so that when you will show the asset, you will say, okay, this is the provision, and accordingly, basically it will be kind of a scenario that, okay, the asset net of provision and total outstanding, the asset value which is there. So the provision is basically knocked off in front of the asset which is there in your financial statement, but that doesn't mean you have to write it off. That's the difference between both of them. You need to understand. Okay. And if I quickly show you, just give me a minute. Let me share my screen to show you guys. See, when I talk about loans, okay, this is a financial statement that we are talking about, which is there on the front of your screen. Okay. Now, what we are talking about, it's a gross value, gross amount. Again, this is ECL calculation, which is being done in front of you. But if you see, we have an impairment loss allowance. Okay. We have something called impairment loss allowance. So it is part of this impairment. So if, the moment I say impairment loss allowance, this includes my provision also. Okay. This includes my provision. And if I talk about normal without basically, without this classification. So see over here, if I show you, again, these are loans, term loans, financial lease receivables, and credit substitute. I need to reduce the impairment loss allowance, and then I need to show the net balance. Okay. So again, secured by tangible asset, unsecured, again, accordingly, I have an impairment loss allowance, again, each of the category, so that this is something, amount which is kind of, the provision that I have booked in front of that. So this is nothing but the provision for the standard asset, substandard asset, and the loss asset, or doubtful asset and the loss asset. And there are other disclosures also, okay, that a particular NBFC is required to disclose in its financial statement with respect to the asset classification. We will see when we will go to the financial reporting part. But as of now, just remember that there are other disclosures also which are there. And an NBFC is required to disclose these things at a much more detailed level because of the regulations. Okay. So we will come in, we will go and we will discuss that. But as of now, just remember. Any doubt till now? Without only happens when indicated by an NBFC, internal, external auditor, or RBS instructions. Like you are talking about loss asset. So yes, loss asset can happen when only there is a, like if an internal or external auditor also says that no, this is a loss asset, they will classify that as a loss asset. But there will be some backing behind that, that why they are saying it should be a loss asset. So with the, with some backing, with some reason, they will classify that as a loss asset, and on the basis of that, it will be then classified as a loss asset. Maybe there could be erosion that the external or internal auditor has identified. Maybe there is a potential threat of non-recoverability which the NBFC or the auditor has identified, and accordingly, they say that okay, this is a loss asset. Clear? Any other doubts? Okay. So that is the provision requirement. Now, when I talk about provisioning this, again, I'll just quickly show you. Okay, let me show you this. There is one query that how it is required to be disclosed. See, this is something called disclosure required as per the master direction that we are, as of now understanding. So this is the financial reporting, financial statement presentation and disclosure directions of 2025, the revised one. And on that, you are required to show this movement of NPA, the net NPA to advances, your opening balance, addition, reductions, closing, and then you have a movement for provisions of NPA. Opening balance, provision made, writing off of excess provision, closing, a lot of things. Then movement of net NPA. Net NPA is nothing but the opening NPA less provision, it is net NPA. So this is some, additional disclosure is required in the books of accounts. And this is one such disclosure. There are multiple such disclosures which are required to be made. Okay. Now, what we understood as of now was basically your NPA and the provisioning for the base layer. We, as of now, only understood NPA and the provisioning requirement for the base layer. We are yet to cover for the rest of the layers also. Okay. So let's understand for the rest of the layers also, like what is the provisioning requirement. Just a second. Just a minute. Sorry for the technical glitch. Just give me a minute. Apologies for this technical glitch. These annual reports are quite heavy, that carries an impact on the. Okay. let me open up a different way. Okay. Okay. Now, again, basically we were talking about the provisioning requirement for the base layer that we discussed. Now let's understand the provisioning requirement for the middle layer, because for the middle layer you have a different provisioning requirements. See, for the base layer we understood the NPA for the 90 days. Okay. For the middle layer, from start itself there was no requirement of the glide path and everything. For the NPA for the middle layer, from the start itself was 90 days only. Everywhere it was 90 days. So in base layer what we did is we said first 180 days and then we reduced it to 90 days based on the glide path. That was the target of the RBI, that we need to align the NPA, okay, for the base layer, middle layer and everything. And that was done, basically that was done through this glide path. But for the middle layer, from start itself it was 90 only. There was nothing additional over there. So it is same as your base layer. NPA will be same as your base layer. Fine. Great. Now let's understand the reporting requirement. Oh, sorry, provisioning requirement. When I talk about provisioning requirement, it is same that we discussed for the base layer. It is the same that we discussed for the base layer. So the provisioning for the middle layer is also same, the provisioning of the base layer. Okay. So the provisioning of the middle layer is same as the provisioning of the base layer. There is no change in that. No change. Only a small change that I want to highlight. One small change. Okay. For the NBFC middle layer, what we discussed is we discussed that the standard asset, okay, for the base layer we discussed that the standard asset were at 0.25, but here the standard assets are at 0.40, like 0.40. So for NBFC base layer it is 0.25 percentage. For middle layer it is 0.40 percentage. So that's the only way, a part where we have changed it. Otherwise, everything is required to be kept same. There will be no difference in that. One more difference with respect to a substandard asset. Substandard asset, we said 18 months. Remember, for the middle layer, we will say 12 months. So substandard asset, we said 18 months. For the middle layer, we will say now for 12 months. Okay. So that's the difference that we are talking about in the middle layer and the base layer. Clear? So two changes. Substandard asset, where we discussed about 18 months in the base layer. So this was 18 months. This is base layer, NBFC, BL. In the same, like when we are going for the middle layer, we are saying it's 12 months. Okay. NBFC, middle layer. And same, doubtful will start from 12 months. Second is 2.2, 2.5% and 0.4%. These are the two changes which are there. Clear? Any doubt with it? Any doubt? Okay. So let's quickly write it in our notes, this also. Okay. So for substandard, for standard asset, the provisioning requirement for the middle layer 0.4%. NPA was up to, but up to 12 months. That will make your substandard asset, and NPA for more than 12 months will make your doubtful assets. Now, when I talk about doubtful asset, it is same. This particular part, secured, unsecured, is going to remain same for the doubtful asset. So I'll just copy, paste, and yeah, doubtful, done. The provisioning requirement for the substandard asset, 10% general, done. There is no change in that general provision. So the only part where there was a change is this 12 months, this 4%. That's it. That's the only change. Nothing else has changed from my base layer to middle layer classification, asset classification, and the provisioning requirement. Now let's talk about one more layer, NBFC upper layer. NBFC upper layer. Why? Because this also is important to understand. When we talk about upper layer bit works in a bit different way. That is something we need to understand now. Okay. When I talk about NBFC upper layer, there are 2 to 3 things we need to understand different is that when we talk about standard asset, there is a separate category wise provision on the standard asset. For example, your SME, like if it is a housing loan to the or loans to the SME, it is 2.5%. Sorry, 0.25%. Now, if it is the housing loan extended at teaser rates, then it is 2%, which will decrease at 0.4% after 1 year. Now, teaser rates means these are the discounted rates, or these are specific rates. Okay, lower rates which are lesser in the first years compared to the later on. So the teaser rates means that lower rates of the interest in the first few years, after which rates of interest reset at the higher rates. So initially you get a lower rates and then you get a higher rates. So if the particular housing loan is at the teaser rate, for the first year, or for the the year when your rates are lower, it will be 2%, and after 1 year from the date when the rates are reset, it will be higher rates are there, it will be 0.4%. Then advance to commercial housing real estate 0.75%. Advance to commercial real estate, other than the CRE sector, 1%. Restructured advance, there is a separate guidelines, we will not go into that. All other loans 0.4%. Okay, so for standard asset in upper layer, we have a categorization. Housing loan and SME loan, that is 0.25%. Housing loan as teaser rates. So for lower rates, it is 2%. For higher rates, it is 0.4%. CRE, residential house, corporate sector but residential house, 0.75%. Corporate commercial real estate, okay, but corporate sector other than residential, that means commercial property and all those things. Okay, it's not a residential house. So a CRE other than RH, it will be 1%. Other 0.4%. This is a standard asset provisioning requirement in case of the upper layer. We will not go into the other details of the upper layer, like other things, but this is the main thing that we need to understand. And rest everything will be there. Like rest everything what we have understood, like 50 to 53 and 20 to 27. If I talk about 50 to 53 paragraphs, that is this one, like the middle layer classification and middle layer working, will directly be applicable to the upper layer. Plus 20 to 27 is a provisioning requirement that we understood for the doubtful, that will also be directly applicable, except for the standard rate. Clear? Now, why teaser rates? Business decision, like, there could be multiple products which can be multiple type of loans which can be provided by the banking sector or NBFC sector. So if there is some teaser rate kind of loan which is provided by the NBFC, then this criteria will be applicable for the standard asset. Any doubt? So we'll go to our notes. Over there, I will keep everything same, just like your this one. Just only part where I will change is the standard asset. Okay, and here again, no NPA is there. Yes, that's a standard asset, but rates as per table. I'll do a star mark, and down here I will provide you the table. Just a minute. Yep. Okay, so by this way we will have our provisioning and asset classification requirement at one particular place, and by this way you will be able to understand everything with respect to the provisioning and asset classification requirement. Table for standard asset provisioning for NBFC upper layer. Okay, simple. Now clear till this particular part? Any doubt? Asset classification and the provisioning requirements, any doubt? Yes, no? Any doubt? That is very important to understand. See, the moment you will do these kind of classifications, if your classification is wrong, your provisioning will be wrong. So you need to understand these kind of classifications. Okay, fine. Now that was asset classification, but there are some edge cases scenarios that we need to understand. What are the edge cases scenario? When I can classify a NPA to a standard asset, when I can classify a particular doubtful asset to substandard or a standard, how should I classify these things? So we will understand few aspects, only a bit of few aspects on that particular area. Okay, so tell me, let's say for example, if a particular asset is an NPA, let's say substandard, doubtful, when should I classify that as a standard asset? What conditions should be fulfilled so that I can say that that particular asset is now standard asset? Anyone? Pretty much easy. From where, when I will classify about the standard asset, like when I will be able to classify a particular asset into a standard asset. Simple. When all the dues are being paid on that particular asset. The moment you pay the dues from substandard, I will classify to a standard asset. So NPAs may be upgraded to the standard only if the arrears of interest and principal is paid by the borrowers. Straightforward. If the arrears and principal is not paid, I will not classify. I will not classify that as a standard asset. Clear? Simple, straightforward. Okay. Now, one more thing that I want to discuss is income recognition. That is something we need to understand. So see, when we started this particular topic, remember I prepared a table that what we are going to discuss and what we are going to, understand. So one such thing was asset classification, provisioning requirement, but income recognition also. Income recognition is also useful, and we need to understand when to recognize a particular income and when not to recognize the income. Okay. So it's pretty easy. It's not difficult when I talk about income recognition, but why it becomes important? Because it overrides your accounting standards and the your accounting reporting, financial reporting framework. So if there is anything specific with respect to the income recognition in the regulations, you need to follow that first, then your accounting standards. Simple. And that's where it becomes very important, because I will not go with respect to the accounting standards, rather I will go with the regulation. If regulation says that, okay, you do not recognize this income, even when I am supposed to recognize as per the accounting standard, I will not recognize. Simple. I will not recognize. Okay. So let's understand the income recognition criteria and specific scenarios of that. See, of interest, discount, higher charges, rentals, okay, any type of income shall only be recognized when realized. Any income recognized before the asset become NPA and remaining unrealized is required to be reversed. Simple. That means we will understand that on NPA, recognize income on, very important, actual realization plus reverse any unrecognized or unrealized, basically unrealized income on NPA. So if there is unrealized income which has been recorded in the books of accounts on NPA, you have to reverse that. Okay. For the loans which are there on the moratorium, okay, if there is any moratorium has been granted on any loans, that's an extended period when you should, for the payment. So what are the moratorium period? Where, the repayment either is not taken or it's been, delayed for the future period. Okay. It's a kind of a waiver period you can understand. If there is this kind of waiver period provided by the NBFC, so the income can only be recognized if I classify that as a standard asset. Okay. If that particular asset after the completion of the moratorium, okay, becomes NPA. So at that point in time, whatever capitalized interest is there is not required to be reversed. So again, a specific scenario for the moratorium based loans or moratorium period. Now you can understand this as a waiver period, nothing else. Okay, there is a waiver additional which is given where you can pay your dues later on. Additional non-payment period kind of thing. Sometimes bank choose that, okay, whatever interest will get accrued on this non-payment period, it will be added to your loan. Sometimes they recover as a additional payment later on once your EMI starts. So there are 2 to 3 scenarios. Sometimes they increase your tenure. Okay, your EMI will remain same, but we will increase your tenure by adding into the loan. Or they will say that no, we will not increase the tenure, we will increase your EMI, keeping the tenure same, and we will accrue the interest or capitalize the interest in the loan account. So the moratorium, loans, okay, recognize interest either for the capitalization for any purpose only if standard asset. Only if standard asset. Okay, and already recognized interest or already recognized plus capitalized interest. Because if you're not capitalized, then you have to reverse it. Remember, it has to be capitalized. These two conditions should be there. Recognized plus capitalized. Then no need to reverse. Now here I will write NPA moratorium loans. Okay. So specific condition for the specific scenario for the income recognition. Clear? Any doubt? And if a asset is there which is stress asset, just for your information purpose, so there are resolution of the stress asset directions. Again, these directions provide that how the resolution for the stress asset to be performed, like restructuring, renegotiation, and all those things. As of now, we will not go into the detail. It's just for your information that for further renegotiation, recognition of income on these kind of assets where there is a restructuring is happening of the loan, there are detailed guidelines given. Those guidelines are required to be followed for the recognition of income. But what we discussed was this asset classification and everything. Then your 32 provisioning requirements, which is there for the 32 is a provisioning requirement, which is there in the your ML also. So ML says that 22-27 follow plus other asset also like 28 to 36, which includes your 32 also. And this is also being also followed for the UL. So ML, everything has been followed in the UL. So by that way, it is also coming over here. See, follow 28 to 36 in addition to the instruction contained in 28 to 36. So same for the doubtful asset. You need to follow over here. Any other doubts? No? Okay. If no doubts, then I would like to discuss now one more regulation. We will discuss one more important regulation now. And that's where this is very important regulation. And this is kind of a new regulation. Okay, new means that has been recently announced. Now we are going into a territory where we are talking about recently announced regulation. Again, before I discuss this, just one thing I would like to highlight. Okay, these set of regulations are announced on 31st of July. Let me show you. So this set of regulation which is there is announced on 31st of July. That means it is applicable for May 27, not applicable for the November 26. So accordingly, you need to understand this. So it's a May 27 batch. We will be covering these regulations. Few days ago, these are announced, and accordingly, we will be covering these regulations. See, basically, just to give you a brief background, the NBFC regulations are divided in two buckets. The regulations issued by the Department of Regulation and Department of Supervision. Okay. So So Department of Regulation for NBFC issues a bulk of regulations on the operating side. For example, income recognition and asset classification, okay, credit card, acceptance of public deposit, then registration requirements, then prudential norms on capital adequacy. This is something which is Department of Regulation does. For the Department of Supervision, they provide the regulation on supervision side. That means auditor's report, statutory audit, supervisory returns, internal audit, compliance functions. So these are the regulations which are issued by the Department of Supervision, and that is applicable from the auditor side. What auditor is required to report, what auditor is required to perform, what is the duties of auditor, what returns the NBFC is required to file, all these things. Okay, and we will start with one such regulation. We will start with one such regulation, which is the auditor's report and auditor's reporting requirement. Why this important is, I'll show you something. Sorry. So basically, we were talking about this annual report. Okay, let's go to the auditor's report. This is Annexure B to the auditor's report and independent auditor's report. Independent auditor's report. Yep. See, this is the independent auditor's report on the standalone financial statement. We already seen consolidated, but we'll go the standalone one. Independent auditor's report. Okay. Now, one thing that I want to highlight over here is it is same opinion paragraph, basis of opinion paragraph, key audit matters that you have already understood till now. Okay. Then you have other information paragraph, and then responsibilities of the management. You will have the responsibilities of the auditor. Okay. You have report on other legal matters, which is section 143.3 and the CARO. We will come to CARO in some time, but this is 143.3 reporting, which is there. Apart from that, is there any other reporting that is required to be done by the auditor? This is the audit report that we have seen, which is reporting which is done by the auditor. Okay, in the normal scenario also. Now here, there is one thing additional that we will see that is being required to be reported by auditor under CARO. Do you know any such paragraph in CARO which requires auditors to report specific about the NBFC? Anything specific about the NBFC? Anyone? Any such paragraph of the CARO which requires auditor to report anything about the NBFC? Yes, no? Yes, about MOF. NOF, okay, yes, okay, Radha. Can you tell me which paragraph it is? Which para of CARO talks about reporting on the NBFC related matters? Which para of CARO talks about reporting on the NBFC related matters? Anyone? I need the para number. Huh? I need para number. Clause 20. I don't exactly remember. Okay. I'll also show you the para. Okay. Basically, when I talk about NBFC related reporting, and again, I'm showing you from the act itself, the CARO itself. It's para 16. Okay, it is the para 16 which requires reporting on the NBFC related matters. This is a specific. Otherwise, you will have this reporting, CARO reporting in applicable based on the requirements in all the listed companies and other companies. But this is specific within the CARO itself, applicable for the purpose of the NBFC. Now, what it says that what auditor is required to report, there are 4 points, okay, under para 316. Okay, para 316. Now, what it says that first point, whether the company is required to be registered under Section 45 IA of the RBI Act, and if so, whether the registration has been obtained. So, tell me one thing, if it is a type 1 unregistered type 1, if this is a unregistered type 1, then in that case, what you will write over here? Anyone? If it is the unregistered type 1, what you will write over here as an auditor? Whether the company is required to be registered under Section 45 IA. If so, whether the registration has been obtained. It's an unregistered type 1. Yes, Radha, absolutely. It's an unregistered. It is not required to be registered under 45 IA. There was an exemption we discussed. So for that, those particular companies, you are not required. You are required to say no. Company was not required to be registered. Simple. Second, whether the company has conducted any non-banking, financial or housing finance activity without a COR from Reserve Bank of India as per the RBI Act. If it is unregistered type 1, it will be required. Say, no, it has not conducted any business. Let's say if it is unregistered type 1, and if that entity has conducted the business, in that case, you will write yes. The company has conducted without a valid certificate of registration. Only you will write no when the company has not conducted any business and it is not required to hold COR. 10. Whether the company is a CIC, that's a core investment company, and whether it continues to fulfill the criteria of CIC. So there are specific CIC regulation. Let us see. Okay. So when we discussed about Department of Regulation, okay, and we discussed about various regulations, you will see I have a specific regulation on core investment companies. Reserve Bank of India core investment directions. Specific directions. Now these directions also requires, they have their specific requirement. For example, registration, like which shall be, which entity can register as a CIC, which entity can register, as a group structure under the CIC. What should be the net worth? Okay, or balance sheet part, off balance sheet item, leverage ratio, capital requirement. Then again, income recognition. Everything is different for the CIC. It may be referring that you follow that, but there might be something here and there addition that we are required to follow for the CIC. Okay. So if an entity is a CIC, you are required to follow these specific directions, and specifically these are the registration directions which are required to be followed. If that is being classified yes, then only I will say yes, it's continue to fulfill the criteria of CIC. Otherwise, it is not. And then whether the group has more than one CIC, then indicate its number, the number of CICs. Let's see this with the help of our live report that we have. So the company is required to and has been registered under 45 IA because this company has the license. The company has conducted NBFC, non-banking financial activities during the year, and company holds a valid certificate of registration. Fine. Company is not a CIC, might not be meeting the criteria, and accordingly, the additional reporting under 316C is not applicable. Now, in our opinion, the group defined in these CIC regulations has 20 CICs as a part of the group. We have not, however, separately evaluated whether information provided by the management is accurate and complete. So what was required to be reported? That whether it continues to the fulfill of no here, whether the group has more than one CIC. If yes, indicate the number of CICs which are part of the group. So management gave 20 CICs in the group, and that has been reported. So this is how The additional reporting under para 316 of CARO is done for the NBFC. Specific reporting of para 316 under CARO. This is specific reporting. Apart from that, there is a general reporting of CARO. That is another story. Clear? Any doubt? Any doubt? Okay. If no doubt, then let's do one thing. Let's take a 10-minute break. After the break, we'll gather back and continue the rest of the discussion for the additional reporting that is done by the auditor. Okay. We will understand some additional reporting which is required to be done by the auditor under these directions only. So let's take a quick 10-minute break. Yep. Shall we continue? Okay. Hello, everyone. Hmm? Huh. Hello, everyone. Welcome back. Let's start the discussion. See, now I want to show you something with respect to a reporting part. Okay, just a bit of more reporting I want to discuss. See, when we are talking about from the perspective of the auditor, so auditor not only is required to report under the CARO, but he is also required to validate the additional reporting which is being done by the management under the framework that is there, accounting framework or the financial reporting framework which is there. Over and above that, okay, there is something additionally required to be reported by the auditor. And now this reporting is required to be done by the auditor to the board of directors. Okay. So this reporting is done by the auditor to the board of directors. Let's understand what is this reporting. And this is basically covered under the Reserve Bank of India. Okay. The NBFC direction, that is the auditor's report direction. Now, these auditors report direction provides that the auditor should prepare a detailed report, okay, and should present this detailed report to the management. So, auditor is required to prepare this detailed reports, and he is required to present these detailed report to the management. And let's understand the content of this detailed report. Okay, and this is over and above the audit report that we have seen. This is over and above the audit report we have seen. Now, do we have a publicly available data for this particular report? That means, do we have a publicly available report, this one? Answer is no, because this is submitted to the board of directors, and from there it is submitted to the RBI. So we don't have a publicly available report, but we will, through this particular reporting, specific reporting requirement, will understand what is required to be reported. Okay. Now, let's understand from the applicability point of view, what is the applicability over here. Now, this is applicable to every auditor of NBFC. Every auditor of NBFC, other than those who are exempt by the RBI. If something is exempt, then it is not applicable to the auditor of that NBFC, but it is applicable to every other NBFC, auditor of that NBFC. Okay. Plus, what is required to be done? This is the auditor to submit additional report to the board of directors. Now, this is not to the members. The way we have seen, annual report or the statutory audit report, that is submitted to the members of the company. Okay, to the shareholders. This is to the board of directors. So, reporting to board is required to be considered over here. Okay. Now, if I talk about this particular scenario over here basically under this particular report, auditor will collect the information, will make a separate report, will present to the board of directors, then board of directors of the company then will submit this to RBI. Okay, then they will submit this to the RBI, and accordingly, the RBI will get this particular report. So it is not a direct submission by the auditor to the RBI or by the auditor to the members. Rather, it's a routed submission that first auditor is required to submit to the board of directors, then board of directors is required to submit to the basically to the RBI. Okay. Now, what is required to be reported by the auditor in this report? Now, there are 4 parts that we will discuss. Under this, there are 4 areas that we will discuss, 4 sections rather, I would say, which is discussed in this. Okay. This entire report is divided into 4 sections. So these sections are: one, auditor's report for all NBFC. So this section is applicable to all NBFCs. Okay. Now this section, second section, auditor's reports for NBFC accepting and holding public deposits, only applicable to the NBFC. B, this auditor's report for NBFC not accepting public deposit. And this one, D1, auditor's report for a company engaged in the business of NBFC or NBFI, not required to hold certificate of registration and under subject to that conditions. So, exemption. So NBFC having exemption. So 4 categories are given in this entire report. There is one question: in practical life, what requirements must an auditor comply with, and where we can obtain all that information while conducting an NBFC audit independently? Like just you said, CARO requirement. See, NBFC is a very detailed area. It's not something that there is 1 or 2 regulations. There are n number of regulations. So to understand the requirement of the audit, you need to understand the entire regulations of the NBFC, that what is required to be reported by the auditor. Let's say, for example, now we will go to auditor's report for all NBFC, part A. See, what is auditor required to report in part A? Okay, in part A, auditor is required to report that conducting and non-banking financial activity without a certificate of registration granted by RBI is an offense. Okay. Therefore, if the company is engaged, then whether it is meeting the criteria, if yes, like based on the 50-50 criteria, then whether it has obtained the certificate of registration, and the auditor of the NBFC shall examine whether the company has obtained the certificate of registration from RBI. Let's talk about this one. If auditor has to report this, for that auditor has to understand, first of all, who are required to get registered. Okay, who are required to get registered in order to say that yes, whether the company is engaged in not. So to answer this question, whether the company is engaged in the business of non-banking financial institution, okay, and meeting the principal business criteria, I need to understand what is principal business criteria, what is the registration requirement, and whether is company required to obtain the certificate of registration from the RBI. So for that, I need to understand these 2025 directions, registration directions. Then only I will be able to answer, about this particular question. So in order to report, auditor must understand the entire ecosystem of the regulations and the directions issued for the NBFC. Then only auditor will be able to answer these questions. So in order to, like the requirements that the auditor has to comply, the entire set of requirements issued by the RBI, which are applicable to the NBFC. So the first question that the auditor is required to report. So auditor is required to examine whether the company has obtained the certificate of registration from the RBI. Now remember, this is applicable to all NBFCs. That means which are not exempt. Not exempt, because if a NBFC were exempt, it is already out in the applicability section. So exempt is already taken out. Other than those are exempted by RBI. So the moment we are going to point number A, that means the NBFC is not exempt, and accordingly that NBFC must hold the certificate of registration. So auditor is required to report that whether the company has obtained the CRO from the RBI or not. Number 2, in case company holding the certificate of registration issued by RBI, whether the companies continue to hold such COR in terms of principal business criteria as on 31st March of the applicable year. Now, can anyone tell me what was the principal business criteria? You have some hint on your screen, but what was this principal business criteria? Can anyone tell me? 50-50. That 50% of assets, okay, or more than that, should be your financial assets, and income from this financial asset, okay, should be more than 50% of total income. Okay, that's the 50-50 criteria. Okay, and you need to say that whether the BFC in this particular scenario, or the company which is there, is continue to hold, is entitled to continue to hold, means every year evaluate whether the company is eligible to hold the COR. Evaluate whether the company is eligible to hold COR, and that too every year. So it's not just 1 year requirement of 50-50, but it is the requirement for each and every year. Okay. So you need to accordingly, report on that. Number two, when we require to report on 31st March of the applicable year, so we need to, based on that reporting of that particular year, we are required to report. Then the third point, that whether the NBFC is meeting the required net on funds, okay, as laid down in the registration directions. So what was the net on funds requirement? Can anyone tell me? NOF requirement. What is the NOF requirement? Anyone? NOF. How much NOF was required? Anyone can tell me? Where we read about the NOF. So now you can link. See, we read something not because that there is a regulation, but because as an auditor we are required to report of that. Okay, not because as a regulator, or not because of as a regulation, but something that we are required to report on that. Okay, so we are basically, you can say that we are reading the regulations so that as an auditor we can report. Okay, we are reading the regulations so that we can, as an auditor, we can report. That's where it's become very important that we as an auditor, okay, understand each and every regulation. So NOF requirement, remember 10 CR for 3 specific categories. Let me take you back to the NOF. So what we discussed in the NOF basically was 10 CR, but for the 3 categories, ICC, MFI, and factor, it was 10 CR, and for the rest it was 2 CR. Okay, for the rest it was 2 CR, but for few categories, that is ICC and that is your MFI, there is a specific criteria that they are required to fulfill. Okay, accordingly we need to understand what category of NBFC it is, and accordingly we need to apply the NOF requirement from regulation, 2 CR or 10 CR. Okay, so accordingly we need to see whether the COR is being maintained or not. Now, how will you calculate the COR? Can anyone tell me? How will you calculate the COR? how we are required to calculate the NOF? Anyone? How we are required to calculate the NOF? How we are required to calculate the NOF? Remember, when we discussed the 45 IA, at that point in time, we started with this only, that we are required to calculate NOF in a particular way. Okay, this was the NOF calculation. Remember, equity, free reserves, accumulated loss, investment, loans, then something we are required to reduce it. So based on that, you will calculate the NOF and then you will compare whether 2 CR, 10 CR is matching or not, and accordingly you will report. Yes or no? Now again, very important part that we need to see. NBFC shall enable statutory auditor to submit DNBS 10, that is the statutory auditor's certificate, written every year within 5 working days from signing of the date of this auditor's report. Okay. So once the auditor signs the auditor report in terms of section 134 of the Companies Act, or 139, which is there, or 143, auditor is required to submit the particular written, which is DNBS 10, and NBFC is required to enable the statutory auditors. That means they need to facilitate them that, okay, they should provide each and every detail. But this return is required to be submitted by 31st of December. Okay, and over there again, and statutory auditor shall verify that the NBFC is holding COR and is eligible to hold everything with respect to the financial year 31st March. So this return which will go, okay, it will contain the details of COR plus eligibility also. Not only this report, but this return also will contain this detail. And again, these are the supervisory returns, additional supervisory returns that are required to be filed. Okay. So one additional point, apart from the specific reporting, there's a reporting of the return, which is DNBS 10, where again auditor is required to report about the COR. That was the part A, where you are required to report on 3 matters. 1 COR, 1 your principal business, 1 your NOF. Okay, so part A contains 3 matters: obtain COR, continue to hold COR, and NOF. Okay, these are the 3 things which is required to be reported in part A for all the NBFC. Now let's go to the part B, which is for the accepting deposit and public deposit, accepting public deposits and holding public deposits. Now, understand one thing: when we will discuss this entire set of section, we have not discussed the regulations, and these regulations we are not required to go in detail. So something you may feel that we have not discussed, which are specific to those regulations. But once when you are an auditor, you are required to understand those regulations also. Okay, but as of now, we are not going. We will not go in detail of these regulations, but we will discuss this, the reporting part. So what auditors is required to report? Under this particular part, auditors is required to report whether public deposit has been accepted by the company together with the borrowing, and if yes, you need to report that from public by issue of unsecured and convertible debenture bonds. So what form of the public deposit you have accepted? So by issue of unsecured non-convertible debenture or bonds, or from shareholders, okay, or which are not excluded from the definition of public deposit as per the directions and within the limits which are given by the RBI. So in which form you have accepted the deposits? Okay, so this is basically the form of deposits. Either it is by the public through the issue of NCD, okay, unsecured non-convertible debentures or bonds, or through shares, okay, from shareholders. So there is a specific scheme for the shareholder under the regulation, or there is something more, not excluded, which is something which is not excluded from the definition of public deposit, means not from item number 1, not from item number 2, but something else. Okay, so this is something else covered under the regulation. Okay, so if yes, then you need to report. Second, whether the public deposit held by the company in excess of the quantum of such deposit permissible under the provisions. Again, there is a quantum provided for each of the scheme based on the rating. Okay, and if you hold more than that, you are required to regularize, okay, in the manner which is provided in the regulation. So to give an example, let's say there is a scheme of NBFC, that NBFC is issuing NCD, non-convertible debentures, okay, which are rated AA. Hypothetical example, AA rating. Now, if there is a AA rating, hypothetical example, the total deposit limit which was given for that particular scheme, let's say, was 100 crores. Now, NBFC actually, accepted the public deposit more than 100 crores. In that particular case, that more than 100 crores will be known as an excess of the quantum of such deposits, permissible, more than the permissible limit. And these permissible limits are, calculated as per the regulations based on the rating and everything that I'm telling you. Now, if there is excess, you need to regularize it. There is a time limit given. Regularize means either return it, or either, take more higher rating, or, convert your scheme into some other scheme and get more, limit or quantum. So there are various ways prescribed in the regulations. We'll not go into those ways, but you have to regularize it. That means you have to bring it below the limit. So for your understanding, bring below the limit the excess portion. Okay, now that is the responsibility of the NBFC. Auditor has to report whether this has been done or not. So auditor required to report on regularization of excess public deposit, if any. Okay, then whether NBFC is accepting public deposit without minimum investment grade credit rating from approved credit rating agency. As I said, each and every public deposit scheme requires a credit rating, and basically, till the time you don't have this minimum investment grade credit rating, you cannot issue a scheme of public deposits. You cannot go ahead and issue a scheme of public deposit, or you cannot accept public deposit. Okay, so for that you need to have this scheme of minimum investment grade credit rating for that particular scheme from approved credit agency in India, and this is as per the directions. Okay, now if I don't have, I cannot proceed, and if I have, okay, then based on that my limit will be counted. Just to give you an example, okay, when I talk about investment grade, minimum investment grade, it is either, okay, B, triple B minus or above, okay, like triple B plus, double B, double A plus, or like that, right? Or, okay, this is an investment grade I'm talking about. Okay, this is an investment grade, and there are multiple agencies like in India, CRISIL, or you can say ICRA, or you can say CARE ratings. Okay, there are multiple, rating agencies. They provide their minimum credit, minimum investment grade credit rating. Okay, so based on the agency wise, you need to see like whether you have a minimum investment grade credit rating for that particular scheme. If yes, then go ahead, accept the deposit up to a limit. Okay. Otherwise, you cannot accept the particular, public deposit under that scheme. That is a scheme. Now, auditor basically are required to understand that whether this credit rating has been obtained or not. If not, then you are required to report. If yes, then fine. So the entire reporting works like if there is a negative comment, you need to report. Okay. Minimum credit rating. Simple, straightforward. Any doubt till now in these points that I'm discussing? Any doubt? See, that's where it becomes important to understand, like why we are required to understand the regulations. Because if you'll not understand the regulations, you will not be able to present this report. If you'll not be able to present this report, that means you are not able to fulfill the reporting requirements of the auditor. And just to show you the credit rating, in our annual report that we were discussing, see, this is something, credit ratings are there. Okay. So if you see, this is India ratings for some bonds which will be there, non-convertible bonds which are there. Okay, they have India AAA stable rating, subordinate debt, long-term rating. Different ratings are there for different type of public deposits. Okay, so this is already there, which the auditor has reported, or the management has reported, and auditor is required to verify this. There is one question. So, sir, this is new introduced expected in the 31st July 2026 auditor reports for NBFC, right? Yes. See, again, this particular part was also there in the old regulations, old directions. So here, what you are seeing right now, this credit rating part was also there in the old regulation, and accordingly, in this particular new one, it is also there. So in old annual reports, you will see this kind of reporting. Plus, in the new annual report in the coming years, you will also see this kind of reporting. So this has been carry forwarded from the old directions. Okay, but this kind of rating is required for all the deposit schemes. Okay, for all the deposit schemes. Otherwise, you cannot issue the deposit. Simple. Any doubt? See, amendment is your entire regulation has changed. That's the amendment part. Okay, basically, if you understand, this regulation was earlier a 2016 regulation. Now you are following the 2025 regulation. They may have taken something from the old regulation, but it is altogether new. It may have some new aspects, it may have some old aspect, but it is entirely a new set of regulations which may have some old plus new elements. Okay, simple. The way we have Income Tax Act 2025, it has carry forwarded something from the old 1961 Act, but also it has something new aspects. Similarly, when I say this is the amendment, that means there are entirely new set of regulations, something from old, something new. Okay, so that was credit rating. So first of all, auditor is required to see whether there is a minimum credit rating, investment grade credit rating or not. Then, in respect of paragraph 7.3, means this paragraph 3, credit rating part, they are talking about. Okay, so credit rating para. Whether any SEBI registered credit rating agency has assigned credit rating, to each of the fixed deposit scheme. Okay, to each of the fixed deposit scheme. You need to verify whether there is a rating or not. Now, whether the aggregate amount of the deposit outstanding at any point in time during the year has exceeded the limit specified by the RBI in terms of the directions, which are again based on the credit rating. So first, whether there is a credit rating for each of the deposit scheme and the aggregate amount of deposit exceeded the limit. Okay. So first of all, whether there is a public deposit without minimum investment grade credit rating. If no, means you have everywhere the minimum investment grade credit rating. Then you need to talk about whether this credit rating is from the SEBI registered credit rating agency and whether the aggregate amount of deposit exceeded the limit. Okay. So first, minimum. Now, if I say yes, then is it from SEBI registered? Okay. CRA, credit rating agency. If yes, then you need to see aggregate amount exceeding the limit. If no, then fine. If yes, then you need to report. Okay. Then whether the company has violated any restriction on acceptance of public deposit given in the direction. There are multiple restrictions. So violation of any restriction. Okay. That is something auditor is required to report. Then whether the company has defaulted in paying its deposit, the interest or the principal amount after such interest or principal became due. So any default by the NBFC. Default by NBFC. Whether the capital adequacy ratio as disclosed in the return submitted to the RBI, okay, has been correctly determined and is in compliance with the minimum CRAR ratio. Now, what was the CRAR ratio that we discussed? Can anyone tell me? CRAR ratio. How we are supposed to calculate that? Anyone? How we are supposed to calculate the CRAR ratios? %12, 15% tier 1 capital plus tier 2 capital. Okay. Absolutely correct. Yes. So tier 1 was 12% and tier 1 plus tier 2 15%. That was for lending against gold jewelry. Yes or no? And if it is not lending against gold jewelry, if it is the other scenario, then it was for others. It was how much? How much? 10 and 15. Maximum of which tier 2 cannot increase the 100% of tier 1 capital. Okay. So if I talk about CRAR ratio, so either it will be 15%, that is T1 plus T2 divided by risk weighted assets. That is something we need to reply. That is something we need to provide in this particular point, whether it has been maintained or not. Yes or no? That's where it was important to understand the CRAR ratio. Otherwise, why would we are required to learn? Because each and every regulation will be now useful in the reporting. Okay. Clear? Any doubt? How everything is being connected with respect to the reporting? Okay. Now, let me show you the regulatory capital that even the NBFC is required to report in their financial statements. So this is not something only required to be calculated and reported to the RBI, but it is part of your financial statements also. This is notes to consolidated financial statement. Same way we will have a standalone financial statement. Over there is a point number, note number 46, capital. Okay. And if you see, they have calculated regulatory capital, which includes tier 1 capital, this much amount, tier 2 capital, this much amount, total of tier 1, tier 2, risk weighted assets, total of tier 1, how much was there, tier 2, how much is there. It should not be more than, it should not be more than 100% of tier 1. Total CRAR, that is 21%. What is the minimum? 15%. They are 21%. So they are meeting the criteria. Plus, the tier 1 was supposed to be 10%. Again, they are meeting the criteria. Even not in the current year, but also in the previous year. Okay. So this is not only of the current year reporting, but this is also the previous year of reporting in that. And they are required to report in the financial statement. And as an auditor, we are also required to, verify whether these numbers are correct or not. We are also required to verify whether these numbers are correct or not. So accordingly, auditor should know how to calculate these. Otherwise, he will not be able to report or verify even the financial statements. So everything is connected when it comes to the NBFC. Okay. So this is CRAR. Now, just a minute. Okay, let me share back. Okay. Now, 8th point, whether the company has complied with the prudential norms on income recognition, asset classification, provisioning for bad and doubtful debts as specified in this regulation that we understood. Okay. And concentration of credit and investment as specified in this regulation. So now we are talking about income recognition. Okay. Asset classification and provisioning norms. Whether the NBFC has complied with this. What we discussed in this. Can anyone quickly summarize what we discussed in these norms? Anyone? What we discussed in these norms? We discussed about NPA. We discussed about asset classification, that's the standard, substandard, doubtful, okay, loss. We discussed their provisions, which ranged from 0.25% to 100%, and how they are required to be reported in balance sheet. Okay, that is something we discussed. So whether these are being complied with or not, that is you are required to report after verifying. Then whether the company has complied with the liquid asset requirements as prescribed by RBI, and whether the details of the designated bank in which approved securities are held is furnished under the DNBS 3, okay, as per these regulations. So liquid asset requirements. So there are liquid asset requirements for each and every NBFC. Okay. The way we have for the bank, similarly, there is a liquid asset requirement for each and every NBFC. And these requirements comes from not only from the directions, but from the act also. Okay. So in act also, we have this requirement of liquid asset, and based on that, each and every NBFC is required to maintain these many liquid assets based on the percentage given, and accordingly, and they are required to furnish this return. If they do not furnish the return, or if they are not maintaining the liquid asset as per the requirement, auditor is required to report that. Then whether the company has furnished to the RBI return on deposit, that is DNBS 01, which is on quarterly basis. So return on deposit. Whether the company has furnished to the RBI return on important parameters, prudential parameters under DNBS 03. Okay, within the stipulated time. So we are talking about some returns now. DNBS 01, DNBS 03. Okay. In case of opening of new branches to collect deposits or closure of existing branches, okay, whether the company has complied with the requirements of this direction. So for the opening up of branches and for the closing of branches, okay, NBFCs are required to follow some requirement directions which are given by the RBI. If they do not follow, then in that particular case it becomes non-compliance for the NBFC, and accordingly auditor is required to verify whether basically how many branches have been NBFC has, and whether these branches are in compliance with the deposits or not, deposit regulations or not. Okay. So based on that, auditor is required to report. Now, if I just talk about the branches, reporting basically. So let me show you in the annual report the number of branches and the relevant details which is reported by the NBFC. At multiple places, okay, NBFC reports in this number in their annual return or annual report. So see over here, 38 branches for this debt management services, or if I talk about some further reporting, sorry. So there are multiple places in the annual report. The NBFC reports on the number of branches, that how many branches it has. Okay. Again, let me run a search and show you. See, number of offices, how many offices are there for the plant and operation and everything, and number of locations and everything, it is being reported by the NBFC. Okay. Again, there are multiple places where these numbers are reported. This includes all the branches and corporate offices. So not even that, there is a detailed reporting also which is done by the NBFC. Okay, with respect to the branches, that how many branches they have. A lot of reporting is done in the annual report, and accordingly auditor is required to verify whether these are in line with the regulations or not. So whether they have complied the regulation while opening up these branches, or whether they have fulfilled the requirements of the regulation. Even if a single branch where the regulation has not been fulfilled, it will become a problem. Okay. Now that was your point number B, where we discuss about the deposit related reporting. So if NBFC is involved into the acceptance of public deposit, then only this reporting will come. Otherwise, this reporting will not come. Now we will go to a part where if NBFC is not accepting public deposit, then this reporting will come. So you have to skip point number 7 and then report directly on the point number 8. First, whether the board of directors has passed resolution for not accepting public deposit. If yes, then fine. If no, then report. Whether the company has accepted any public deposit during the relevant period, because company was not supposed to accept public deposit. Then whether the company has complied with the prudential norms, similar. In respect of the NBFC in the middle layer, okay, in respect of the NBFC in the middle layer and above, as defined in these directions, whether the capital adequacy ratio or minimum CRAR ratio has been complied, okay, whether the company has furnished the risk asset exposure risk asset ratio in the DNBS 03. So again, some reporting is there. Okay. whether the NBFC has correctly classified NBFC MFI in terms of these regulations. Why? Because if it is the MFI, microfinance institution, okay, then the different NOF requirements are applicable to this NBFC. Different set of regulation is applicable to NBFC. So that is something required to be reported. And point number D, if a NBFC is engaged in the business of non-banking financial institution, which is nothing but 45 IC and 45 IF, okay, then where a company has obtained a specific advice from the RBI that not required to hold COR, the auditor shall include a statement that the company is complying with the conditions. So there are certain scenarios where company can obtain specific exemption, that although we are engaged in the business of non-banking financial institution, but we will not hold the certificate of registration. Okay. In the business of non-banking financial institution, but not required to hold certificate of registration. So if there is a specific exemption given to a particular NBFC, then report this. Otherwise, most of the scenario will not applicable. And auditor is required to report only when there are unfavorable or qualified comments. And auditor is required to provide reason for the unfavorable and the qualified comments. Plus, where the auditor is unable to express any opinion, then auditor is required to provide the fact why he is unable to express the opinion on any of the point. So that is the reporting that is required to be done by the auditor in 4 parts to the board of directors. Okay. Any doubt, any of the part that we discussed? Any doubt to the any of the part that we have discussed? Any doubt? It will be there. Don't worry. It will be provided a summary. I will include in notes for you. Any doubt? Any other doubt? Because this is very important to understand what is being reported by the auditor to the board of directors, and then all these regulations and compliance of all these regulations in this report. No? Okay. If no further doubts, then I would like to discuss one more set of regulations. Okay, one more set of regulations. Again, these are applicable to the statutory auditor. These regulations are also applicable to the statutory auditor. Now, why these regulations are important? These regulations are important because this is relevant to the appointment of statutory auditor. Okay. Here now we will discuss something with respect to the appointment of the statutory auditor, which is the non-banking financial company statutory audit directions 2026. Again, this has been issued on 31st of July, and accordingly this is applicable to the May 27 exam. Okay. Now let's understand about this particular regulation. What is this regulation is about? Overall, this regulation provides the eligibility criteria for the auditors, number of central statutory auditor or a statutory auditor for the branch should be there, independence of the auditor, professional standards that the auditor is required to follow, tenure, rotation, audit fees, appointment procedures. If I summarize, the things which are given under section 139 of the Companies Act, 140, 141 of the Companies Act, extension to that. Okay, extension of section 139, 140, 141 of the Companies Act is discussed over here. And that's where it becomes very important for the auditors to understand this requirement. You are required to see whether you have complied with the section 139, 140, 141 of the Companies Act before being appointed, okay, or at the time of appointment. Similarly, now auditors are required to check for the NBFC whether they fulfill these criteria or not. If they are not able to fulfill these criteria, then there is a problem. They should not accept the appointment. Okay. So it's very important for the auditor to understand this criteria which is provided. Okay, let's understand few of the criteria which are given in this, okay, which are applicable to the auditor. And based on this, then we will understand, how important they are. Okay. So the first thing that we are going to cover is the number of auditors. Okay, because now it is not something that the auditor can be freely appointed for a particular audit. No. Here, the number of auditors are required based on the like how many auditors can be how many NBFCs can be audited by a particular auditor, or how many central statutory auditor be there. A lot of things are there that we will discuss. So let's start with the number of central statutory auditors and branch auditors coverage. How many of them can be there and what are the scenarios? Okay. So basically, NBFC with an asset size of 15,000 crore or above as at end of the previous year, okay, are required to make sure that they are audited through a joint audit by minimum 2 audit firms. Okay, for a 15,000 crore and above, it should be a joint audit. Minimum 2 auditors. Okay, minimum 2 auditors should be there. And that too, they should not have any common partners in them. That is the first of the requirement that the auditor is required to check. So if you are auditing the NBFC with the asset size of 15,000 crore and above, you cannot accept that directly without having a joint auditor with you. And that should also, you should not have the minimum, you should not have the common partners in that. One important requirement. Okay. So that is the one thing that we are required to look into. Number two, now maximum numbers of central statutory auditors and branch auditors that can be there. Now this is again based on the asset size of the NBFC. Okay, what this means is that considering considering the asset size, okay, the board has to decide how many maximum number of auditors they can appoint. Maximum number. So not only the minimum number, but there is a maximum number also. So based on the asset size of the NBFC, and it is up to 5,000 crores, maximum number of central statutory auditor and the branch auditors and everything can be 4. Okay. If it is 5,000 and 5 lakh crores. Okay. If it is 5 lakh crore to 10 lakh to 6, then 10 lakh to 20, 8, and above 20, it is 12. The maximum number of statutory central auditors that can be appointed by the NBFC. Okay. So now we are seeing a cap on the maximum number. Okay. Then beyond this, we are required to also see that the duty of these statutory central auditor with respect to the audit. So now the statutory central auditor is required to at least to 20 top branches and the 20% of the branches of the NBFC. If the NBFC is having less than 100 branches, then 20% of the branches and at least top 20 branches selected in the level of outstanding advances, so that they can cover the minimum 15% of the total gross advances of the NBFC. That means whosoever the central auditor is there, he is required not only to audit as a central auditor, but audit at least top 20 branches plus top 20% if branches are less than 100. Okay. Plus he needs to cover 15% of advances. Okay. Gross advances as an auditor, so that he can have a good picture or a better picture of the NBFC. It should not be the case that majority of the branches are being audited by a branch auditor and only central auditor is covering one branch and the entire consolidation process. No, he has to deal with at least 15% of the gross advances or such number of branches that at least he should be able to comply with this number. Okay. Plus, there is now additional requirements with respect to the eligibility criteria of the auditor. So you cannot appoint any auditor. So NBFC appointing the audit firm as the central statutory auditor or branch auditor, he needs to fulfill this requirement. So let's say if the NBFC has a 15,000 crore and above the asset size as of the previous year, then minimum number of full-time partners associated with the audit firm for the period of at least 3 years, 5. So if the asset size is 15,000 crore and more, then minimum number of partners required in that audit firm is 5. If it is 1,000 to 15,000 crore, then 3. And if it is less than 1,000 crore, then minimum number of partners 2. Okay. This is not mandatory for the asset size up to 1,000 crores. So up to 1,000 crores, this is not applicable. Out of the full-time partners, minimum number of fellow should be 4. So out of 5, 4 should be fellow. Out of 3, 2 should be fellow. And out of 2, 1 should be fellow. Plus, out of these partners, out of the 5 partners, the partners with the CISA or ISA qualification should be 2, 1, and again 1, minimum 1. Again, not applicable for up to 1,000 crores. Minimum number of years of audit experience of the firm should be 15 years, 8 years and 6 years. So what is the scenario is that, let's say Mr. A, okay, FCA, has been appointed the statutory central auditor for NBFC A having asset size of rupees 20,000 crore. So joint auditor required. So Mr. A and Mr. B, they are appointed. Okay. Mr. A and Mr. B, both are FCA. They are appointed the central statutory auditor for NBFC. Now, if these are the 2 joint auditors, they have complied with the regulations which were given above. But now, one set of regulations requires that, okay, no, if your asset size is more than 15,000, so you cannot have an individual auditor as a central statutory auditor. You cannot have that. You mandatorily need an audit firm with minimum 5 partners, minimum full-time partners as a 5. Out of these 5, at least 4 should be FCA, 4 should be FCA, and 1 can be ACA. And out of these ACA and FCAs, okay, at least 2 should have CISA or ISA requirement, ISA qualifications. Plus, the audit firm that I'm talking about should have at least 15 years of experience of audit. And the professional staff that is required should be 18, apart from the partners. So all these requirements are required to be fulfilled by the auditor before getting appointed. So if, let's say, you are Mr. A, who has been approached by NBFC A having asset size of 20,000 crore, you will not accept the audit requirement. You will not accept the audit because these conditions are required to be fulfilled. Minimum number of partners, full-time partners, okay, and minimum numbers of, CISA qualification and everything. So that is a requirement that is you are required to look into. Okay. So this is a requirement which is there, eligibility requirement for 1,000 crore and above, NBFCs. In addition to section 141. So this requirement is there in addition to section 141. Okay. Now the question is, are you required to remember all these numbers like 4, 5, 2, 15? This is for your understanding. It is not something that you are required to go in this much detail in the numbers. These numbers are for your understanding, but you are required to understand there are additional requirements with respect to the full-time partners, with respect to the CISA, with respect to the professional staff, in over and above section 141 of the Companies Act. Okay, so in numbers may not be applicable, but the requirement is applicable to you. So this part, you can say that, okay, this part for explanation only, for understanding only. But this part that these requirements are there, that is something you need to understand. Okay. So if you have a doubt that how we will remember the number 542115, as of now, don't go into the number. Just remember these kind of requirements are there. Okay. Now, again, there are additional requirements for the, whatever we are discussing. If I just show you for our understanding, these are additional requirements also in the, what you can say, like experience and professional staff. A lot of things are there. Additional considerations. So there are additional considerations. We are not required to go in that detail for that. But just for your understanding, there are certain things. So you are required to only remember that in case of the eligibility criteria, the eligibility criteria works on full-time partners. It works on, FCA. It works on CISA and ISA qualifications. It works on professional staff, number of professional staff. That is something you need to require to remember over here. Above, this is required to be remembered. What we discussed here, it is fully applicable. Here, again, you need to require to look into this fully. So these pointers are fully required to be remembered, what I discussed. Only this part that I'm, table that I have highlighted the numbers, you can as of now ignore. This is for your understanding. Okay. Then, again, now we are not required to go in further detail of these additional eligibility criteria. No, it's just, there are some additional criteria also for your understanding, but we are not required to go in detail. There is something called independence requirement of the auditor. Okay. Now this independent requirement is over and above the independence requirement which is there in your professional ethics code, code of ethics, in your Companies Act. And here, basically what you need to understand is there is a responsibility placed on the audit committee or the board, okay, to intimate to the Department of Supervision of the RBI that there is something which may hamper the audit process, and there is something which is which is creating a problem. So the board or audit committee is required to monitor and assess the independence of the auditor, and if there is anything, then they are required to report. Okay, so the ACB and board is required to monitor and assess, okay, the independence of auditor, and required to report to DOS, Department of Supervision of RBI, if anything is identified with respect to the independence. Okay, this is the thing that we need to understand. So there is a responsibility on the audit committee and the board of directors to report. Now there is one additional requirement with respect to the concurrent auditors. So concurrent auditors of the NBFC cannot be appointed as in central statutory auditor or the statutory auditors of the same NBFC for at least 1 year. Okay, they should not be considered. And basically, after they cease to be a concurrent auditors, there is a 1 year cooling period. So basically, the point here is this is being drafted so that there should not be any conflict of interest. Okay, so concurrent auditors are not required to be considered for these statutory central auditor and statutory auditors. Clear? Plus, there is some other requirements also. Section 144 of the Companies Act is there, which is already applicable to the NBFC. Okay, that is required to be followed. We will not cover over here, but it's applicable. Okay, so if a NBFC is providing, if an auditor is providing tax audit or tax representation service or something like that, it may create a conflict of interest. But usually you need to understand that whether actually it's a conflict of interest or not. So there are a lot of factors. For example, let's say the auditor is also doing a certification work required by the central statutory auditor. It may not be a conflict of interest. So from case to case basis, you need to understand whether this is a conflict of interest or not. Clear? Again, there is a requirement of professional standards. So auditor is required to follow professional standards, okay, with highest audit responsibility and highest diligence. We know that. Tenure and rotation. So there is something with respect to the rotation and tenure requirements. Okay. Now, basically what this requirement is. So the requirement says that the central statutory auditors and the statutory auditors can be appointed and shall be appointed for continuous period of 3 years, subject to qualifying the norms. So now they are appointed for continuous period of 3 years. Companies Act may give you 5 years, but here you need to follow the period of 3 years. Okay. Once they complete tenure of 1 or 2 years with any NBFC, they are permitted to complete the balance tenure, okay, respectively, if they fulfill the eligibility norms on the annual basis. Okay. Now, if you are removing an auditor before the completion of 3 years, you need to inform the RBI. So if any auditor is being removed before the completion of the tenure, you need to inform the RBI. Okay. And accordingly, this tenure is prescribed, 3-year tenure, which is the central statutory auditor is basically there. Now, the one thing is here the tenure of 6 years is given. That is the 2 tenures of 3 years, after which an audit firm becomes ineligible for the appointment. unlike the company sect where you have a 5 year of 5 AGMs tenure, okay, sorry, 5 years of a tenure and tenure, 2 tenures of total 10 years. Here we have a 6 years, 3 years, 2 tenure, okay, after which it becomes ineligible to be appointed for the auditor of the NBFC. Okay, so 3 year tenure and maximum 2 tenure, total 6 years is allowed. Okay, so this is how audit firm can only serve up to 6 years as an statutory auditor for the NBFC, which is different from the Companies Act. So these requirements you need to apply over and above the Companies Act. Companies Act may permit 5 years, but the now directions do not permit 5 years, so you need to follow these 3 years requirement. Okay. So these are certain requirements which are applicable. Again, now there is again, appointment procedure. We will not go in much detail for the appointment procedure. Okay. But, the thing is, just one thing we need to understand is that RBIs are not required to take prior approval for the appointment of auditors. Okay. NBFCs are not required to take prior approval of RBI for the appointment of the auditor who are under this particular region, Mumbai region. Okay. They will be, basically, they need to approach the central office of RBI for the appointment of the statutory auditor every year. But, what is the scenario is for other NBFC, they are not required to take prior approval. They are required, but the NBFCs which are in the Mumbai region, they need to approach the RBI. And every year by way of a certificate, which is there in the Annexure 1 or Form A, which is there with these regulations, within 1 month of the appointment, they are required to approach. So prior approval is not required, but you are required to approach. Okay. After the appointment, within 1 month. After the appointment, within 1 month, reach RBI. Simple. No prior approval, but you reach to the RBI after appointment within 1 month with this certificate, like in Annexure 1 Form A. Okay. This will contain the detail. Okay. And for Mumbai, there is this division, and for other, there is this division, which is, based on the location. So we'll not go into much into the locations, but this is how the procedure works. Okay. Any doubt with respect to this? Any doubt? Whatever we have discussed till now. Professional standards, yeah, ऐसे only. So professional standards are the standards on auditing that they are required to follow. Any doubt? No? Yes? See, these are certain regulations which override basically the appointment of the auditor beyond Section 139 of the Companies Act. That's why it becomes important to discuss the changes compared to the Section 139. So 139, because NBFC is a company, okay, it may be a listed entity under the Companies Act. So they are required to follow Section 139 of the Companies Act. But this regulation overrides Section 139. That's why it becomes important that not only you are required to comply with Section 139, but you are required to comply with the additional requirements provided in these directions. Okay. Any doubt? So what we have discussed today, a lot of things, yes or no? I hope you are making the notes with me, because this is very important. Your notes will be helpful. So what we discussed today, we discussed about the asset classification and the provisioning, NPA percentages, for base layer, middle layer, and upper layer. We started with that, the asset classification and the percentage. Okay. We discussed about the non-performing asset criteria in detail for the base layer, for the middle layer, 12 months, 18 months difference. For the upper layer, also we discussed about the standard asset classification table, percentage table for the provision. Then we went on the income recognition criteria. Then we went on the audit report, the specific reporting that is required to be done by the auditor. I will include a summary of this in the notes for you guys. Okay. And also some important highlights of the statutory auditor appointment, tenure, some limit with respect to the number of and minimum and maximum number of statutory auditors that can be appointed for the NBFC. Again, I will include a summary of this in the notes. Clear? Any doubt on whatever we have discussed today? Any doubt? Okay. If no doubts, we keep till here. Okay. And in the next session, we will take up a lot of questions on whatever we have discussed. So we'll start with the question session. We will discuss the practical scenarios on these particular areas. We will discuss how to write the answer, how calculation based questions can come, and how to solve those questions. Okay. And then we will move to the unit number 1. There is something more we will be taking up with fraud and financial reporting part, schedule 3, quickly. But for after that, we will move to the unit number 1. Okay. If no further doubts, then I propose to keep the session till here. Okay, guys. Thank you. Thank you for participating in today's session. I'll see you in the next session. Yes, session over. Thank you.